We have a guest here, as you guys see. Many of you already know him, Amir Razi with Own Home Loans, our CEO, president, loan officer, everything.
All in one. Huh.
So,
it is so competitive out there right now, you guys. I know you're exhausted. Whether you're a listing agent or a buyer's agent, I mean, I talked to a few of you over the weekend that were just tearing out your hair, whether it was fielding all the phone calls that are coming in on your listing and the 24 offers that you're getting and trying to present to your sellers, or being one of the buyer's agents that is, you know, sending in one of those 24 offers, trying to be as competitive as you possibly can. So it's nuts out there, and we feel your pain, and we're trying to do everything we possibly can to arm you and your clients with competitive advantages so that you can be the one that outshines the other 23 people that have also submitted an offer. Yeah.
So yeah, it's tough. It's very tough, and you guys are working hard.
Working your tails off.
Yeah.
Working your tails off. So hopefully we will have maybe a little tip or trick that you aren't familiar with.
Or just something you haven't thought about. So, and the way that this came about is Paul and I were chatting about cash offers and conventional loans, and just how, you know, all of you are like, I can't compete with a cash offer. I can't compete with a cash offer. And I was telling Paul, it's like, well, you can compete. Mm-hmm. The things that we do on a conventional offer, you know, we have the appraisal gap, or we have an appraisal, you know, contingency. We have our loan contingency. We have all these contingencies because we're getting a conventional loan. And I told Paul, you know, people say, well, I want to make my earnest money go hard. How do I make it go hard? Well, you don't write in something that says earnest money to be hard. What you do is you eliminate contingencies.
Yep.
And so I was saying, you know, you don't have to have a loan objection deadline. You don't have to do that. If you feel 100% confident that your credit's good, your money's good, you don't have to do it. And he was like, what? Well, I thought all these dates and deadlines were for the loan.
Were required by the lender.
Not required by the lender.
To protect the buyer.
Yeah, it's for you to get your earnest money back in case something goes wrong. But if you're so confident in yourself and in the process and in your lender that you're going to get the loan, you can eliminate all of these. Now, of course, that means your earnest money
is at risk.
So we've got a mirror. We've got the perfect person to ask, okay, how risky is this? Because the last thing we want you to do is tell your buyers, hey, put a $30,000 earnest money out there.
And waive all the contingencies.
If they're not 100% confident that this is going to happen. So, Amir, what's your take on people not having contingencies? How do you vet a buyer in the beginning before they've written an offer so that they know, I'm solid. I'm as solid can be, as long as there's no natural catastrophe or man-made catastrophe that we're not ready for?
So for me, there's a few different categories of risk when you're writing a contract that way. And if we look at it from the loan side, as far as the risk of the loan falling through, which is obviously a big fear for a lot of people, I have a stat that I can give that's related. Last year for 2020 on home loans, we didn't have a single transaction that we didn't close that we issued a pre-approval letter on. So anything that we issued a pre-approval letter on closed. And well, with the exception of some loans that fell out for inspection, right? But that's something that's not really related to the financing. That's the buyer withdrawing because they weren't happy with the results of the inspection. But you know, as far as the loan's concerned, if you're getting your buyers in early and they are properly pre-approved and evaluated by an underwriter, there is not a significant risk. Now, there is risk, right? They could lose their job. There's things that could happen that are really outside of everybody's control. But that's something that, you know, you have to discuss with your buyer if they're willing to do. I mean, If you're working with a really solid lender that you know has thoroughly underwritten that buyer prior to contract, the chances are very low that that's going to fall through due to financing. There's appraisal risk, right? The appraisal thing right now, I think, is kind of interesting because almost all offers right now are being written with appraisal gaps, which to me personally makes the appraisal contingency kind of superfluous because you're already kind of agreeing ahead of time that if the appraisal comes in low, we're going to make up the difference anyway. So, there's very few edge cases where it makes sense to include an appraisal contingency with an appraisal gap, in my opinion. Now, there's some, time, Stacey, can add to that, but, given those two things, there's good reasons right now to write without contingencies, assuming your buyer understands the risks. And the way a lot of these offers are being written, at least the ones that come across my desk, buyers are kind of throwing in everything with the kitchen sink anyway. So is it going to make a huge difference to them to place $3,000 or $5,000 or whatever that earnest money is on the line when it's likely a very tiny risk they're actually accepting with all these appraisal gaps and everything else that are being written into these contracts?
Yeah, perfect. And true life story. You guys know that Stacy and I bought a second home in Arizona. Well, we went to a mirror and we didn't have a loan on our current property here in Denver. And we went to him and said, can we just take out a second? Well, I guess it's a first. It's not even a second.
Not even a second. Can we take out a mortgage?
Can we take out a mortgage? Like, yeah, and we ran our numbers, looked at everything, and it looked 100% solid. So when we wrote the offer in Arizona, we said, yes, we're getting a loan. It's not cash, because I still have to get the money. And we've talked about that already. So, yes, we're getting financing, but we had no appraisal. Mm-hmm. We had no loan termination. We did an inspection, but it was, we didn't care if it came in short, if it came in high, the appraisal, we had enough cash on hand to cover what. So it looked almost as good as a cash offer, other than the money wasn't sitting in our bank, but we were willing to risk a very large earnest money.
Yeah, and we did not have an appraisal gap because we waived the appraisal contingency altogether.
We actually got the place for less than full price. Mm-hmm. There was another offer that came in that was cash, mm-hmm. and full price, but they went with ours. We had a much larger earnest money, and we had a quick closing on it. Mm-hmm. And that's kind of what I wanted to also talk about is earnest money. So let's say you've got a cash buyer and you have a conventional buyer. You've got both buyers. The conventional buyer is feeling good, feeling solid, already been pre-approved, and is going to waive their loan contingencies, is going to waive their appraisal. They're going to get the loan. Mm-hmm. Now the guy with the conventional comes in, let's say, with a $30,000 earnest money. And the guy with cash, which we love cash, everyone's all excited about cash, comes in with $10,000 because he's like, I got cash. This is slam dunk. That's the best. What do you think really is the best here? Who do you think really is the strongest buyer? Stacy, why do you think that conventional person with $30,000 earnest money is a stronger person than the cash buyer with $10,000? And we're talking about the type of person, mm-hmm. and the ability that these people have to follow through. Because remember, the earnest money at the end of the day is showing my commitment to make this thing happen.
Mm-hmm. So in theory, the higher the earnest money, the more skin you have in the game, the more likely you are to be able to follow through with that purchase. If you have very little invested, you're willing to walk away. And if you have extra money on hand,
It is so competitive out there.
It might not be that big of a deal for you to lose a $5,000 earnest money or a $10,000 earnest money, but a $30,000 earnest money, you're going to figure out how to make it happen.
Yeah, and so Amir and I were talking about this as well. And what were your thoughts on that cash buyer that might have a little bit smaller earnest money, the personality type, or the ability for that person to make decisions or change their decisions?
They don't have to follow through, right? If they are in love with a house and they have cash and another house comes along that they like better, there's nothing stopping them from placing an offer on that and pulling out. So, I mean, yes, they have some earnest money at risk, but not as much as a conventional buyer. So, that's just one example, but it's not always a sure thing, especially as sure the thing as I think a lot of agents think it is.
Yeah, and
that's usually the reason why we all get so excited about the cash buyer is because of the lack of contingencies. It's not because they have cash or they have a big earnest money. It's they don't have a loan contingency. They don't have an appraisal contingency. So if someone else getting financing can remove those exact same contingencies, you really aren't looking at that big of a difference.
Yeah. So in the end, now it's going to come down to really the earnest money or the desire of that person following through. And, a person with that much cash on hand and a smaller earnest money, especially in this market. I mean, we're talking, someone may be buying a $700,000 home, which isn't that expensive of a home nowadays. But that's only a couple $100,000 more than they average. So if that person has $700,000 cash hanging around and he's got 10 or 15,000 in on this property, and something better comes along during that 30 days, because even cash deals are taking 30 days. They've got, maybe they're moving or whatever.
Money.
15 grand, if I can go get something that I like better, I'll walk away from it. I've had people walk away from 20 grand, and that was 20 years ago that people could walk away from 20 grand on earnest money in that price range and with cash. So a conventional buyer, no contingencies, large earnest money, you can beat out a cash offer of the same price. Amir.
I'll just add a comment on closing times, because depending on the seller, sometimes that's a factor. And, with the more well-qualified the buyer is, chances are the faster they can be closed. And we have situations where we have a large bucket of buyers or, buyers that can qualify for a very quick closing, even 2 weeks in a lot of cases. So if it's a closing time, if the closing window is important to the seller, and it may or may not be, reach out to us and, we can let you know right away if we have a pre-approved buyer, somebody who sent us early, if we can get them closed quickly. 3 weeks is very, very comfortable for us right now, but in a lot of situations we can go faster than that. But everybody's situation is different, so reach out, because if that's a factor that you think is separating you from a cash offer, let us know.
Great.
Awesome. So we definitely getting some questions here.
Yeah.
And I want to restate, we are talking about a strong conventional buyer.
Yeah.
And the strength is more than just that he's approved or she's approved or they are approved or whoever the group is. It's that they probably even have some extra cash. Because remember, we're talking about, let's waive an appraisal condition. Okay, to be able to do that, again, you need to have more than just your 20% down payment. I mean, we're talking.
Yeah. You need to
I've got a couple $100,000 in the bank. I don't need to use all that. I'm gonna go get a loan for $500,000, and if I have to bridge $20,000, $50,000, $60,000, I've got cash. I'm not worried. But if you're someone who's tight, and if it doesn't appraise, well, we're not talking those types of buyers. Okay, we are trying to beat out cash. Okay, so and cash is someone that's got $500,000 sitting in the bank. $750,000 sitting in the bank. So we're not trying to compare that person with, I see a question from Karen, with an FHA buyer.
Yeah,
Okay.
they're
Unfortunately, these are two different types of people with wherewithal to be able to overcome issues that might arise, and they're going to figure it out because they do have some extra cash beyond just your basic 20% down, 10% down. They've got some stuff in the wings. They've got some extra money to help them out with that.
Yeah, I mean, your FHA buyers right now, are typically those that don't have as much money to put towards a down payment. I mean, some people are just wanting to leverage the great interest rates and keep more cash in the bank. But typically speaking, those FHA buyers do have limited access to cash. And therefore can't do the big appraisal gaps, can't waive appraisal contingencies, and may or may not be able to waive that loan termination altogether. So
yeah, unfortunately, they are not as strong of a buyer. They just don't have the ability. The bank is financing 97%. I mean, somebody who needs 97% of the financing, isn't as strong as somebody who's coming in with 80 or 70 or 60% that they need because they have some extra wherewithal to cover any of that stuff. So unfortunately, Karen, no, an FHA buyer it's a very tough time for someone who's got limited funds. For all of you, even in a conventional, if they're a 90-10 or even an 80-20, but they're stuck. I mean, I am maxing myself out with that 20% down payment. Well, then this obviously is not what we're talking about, helping them. But if you got 20% down, and I got an extra $50,000, $60,000, $80,000 that I can pull from, maybe it's in an investment, it's sitting in my savings. That's the type of people we're talking about. Again, we're trying to compete with cash.
yeah, and I know Karen, you and I did speak over the phone, and I had a couple of strategies for that FHA buyer, and just for the rest of the audience, real quickly, those were increasing earnest money if the buyer has the ability to do that to show that they are very, very serious, and tightening the contingencies down as much as possible. Doing that inspection quickly, doing that appraisal quickly. If you can do an appraisal gap, that helps, but really having a really high offer price is going to be the edge that those FHA buyers have to have.
Do you have any tips on that, Amir?
Yeah, I just want to piggyback on that FHA thing just a little bit because I talk to a lot of agents who assume that FHA loans are really there for the lowest down payment, and that's just not the case. FHA loans don't come into play the same way they did pre-pandemic, and the down payment requirements on a conventional loan for a first-time home buyer or for somebody who is making 80% or less of the area median income for that county actually have lower down payment requirements than an FHA loan. You can do a 3% conventional loan. So if you have a lender who is telling you that the buyer is FHA only, make sure that that's the case. It's not always the case. I think I had at least 3 buyers last year that thought they only qualified for an FHA loan, but they actually qualified for conventional conforming loans. So make sure that that's the case, because as you know, it definitely can affect your chances of getting your offer accepted. But down payment is not, there's lower down payments available than FHA loans.
Erica Labath asks, are there any instances where you cannot waive appraisal, like with certain types of loans?
So I'm assuming this is waive the appraisal contingency on the purchase contract, because you have a waived appraisal in the loan, which is different than waiving the contingency. And, as far as the underwriter is concerned, there doesn't need to be an appraisal contingency on a purchase contract. Waiving the appraisal through the loan is a totally different thing, but there's really no instances where you have to have that appraisal contingency in your purchase contract. Now, the appraisal still needs to happen one way or another, and that could potentially be a desktop appraisal if your seller, was like, well, why are you sending an appraiser if you're waiving the appraisal? We can do a desktop appraisal in those situations where they don't even know the appraisal happened, and it takes 2 or 3 days, and we've got it. So there's a lot of tools we have at our disposal that we can use. But an appraisal of some sort usually has to happen unless it's truly waived through the loan, and that happens in situations where somebody's at least putting 20% down. Stacy and I had a deal, which I think we won because we waived the appraisal, Stacy, and we could close it super duper fast.
Yep.
That's a little different, I think, than what Eric is asking, but yeah, don't have to have an appraisal contingency on your purchase contract.
Yeah, and that was the first time I had ever waived an appraisal contingency, because in my mind, I didn't actually put two and two together that that could be done with a lender that you really trusted. And when Amir said, you know what, these guys are golden, they're good to go, if they're comfortable waiving that contingency in order to beat out, you know, one of these other 6 offers, you guys can do it. And that was what the listing agent said, put us above and beyond anybody else. So yeah, that was key for us.
So that was a really good question,
Yeah,
Erica. And
thank you, Erica.
Just re-emphasize, if anyone was grabbing a cup of coffee or something and missed, when we're talking about waiving things, yes, we're talking about waiving contingencies whereby your buyer can get their earnest money back if something goes wrong. The things are still going on in the background. Mm-hmm. The lender is still doing their appraisal. They're still making sure your credit's good. They're still doing everything back in the background. You just waived the right that if anything goes wrong, you're going to lose your earnest money. So you're very confident that if the appraisal doesn't come in right, I've got the means to make it right. If your credit comes in bad, or you go and buy a car during the transaction, I mean, we've got the little list of 10 things.
Thou shall not.
Thou shall not. Yeah, if they screw something up during that time, they're gonna lose their earnest money, because you made this non-contingent.
You want to be very confident in the employment, and you know, are you in an industry that's, you know, maybe fluctuating a little bit right now with the pandemic? Is there a potential layoff or a pay cut? Or, I mean, there's a lot of things that go into making that decision. We do have another question from Rocio. She did ask, you still need a 700 credit score for a 3% conventional, right?
Yep.
Okay.
No, those, you know, these minimum credit score things pop up a lot because lenders have what are called overlays on underwriting guidelines. And underwriting guidelines stem from the agency that's either insuring or guaranteeing the loan. So for a government loan, like an FHA loan, that loan's insured by the government. FHA has its minimum requirements. Conventional conforming loans like Fannie Mae and Freddie Mac, you know, they have their own requirements as well. But lenders place additional requirements on top of those requirements, and those are called overlays. So the 700 credit score, that probably was for a specific lender that doesn't allow first-time homebuyers, anybody putting less, you know, or 3% down. They have to have a minimum FICO score maybe for that lender, but that is not, that's not the case for Fannie Mae and Freddie Mac. Can actually have a much lower score than that.
Can you give us, what do we require, or most of our loans?
Our minimum, and I will say this with an asterisk, the minimum credit score that we can do for a 3% down loan, conventional conforming, is 620. So much lower than people think. With that being said, you typically don't see somebody with a 620 and 3% down. There has to be other things that come into play, like the low debt ratio, or other factors that offset some of those risk factors. So, you know, you have to very carefully and early, you have to evaluate that person very early on, so you know exactly what they're dealing with and what their risk is, you know, for the loan going through. If the debt ratio changes, does the loan still work? You know, all of those pieces have to be considered, in my opinion, prior to placing an offer.
And I just want to throw out, I mean, I'm real excited, obviously, that we have our own mortgage company, and something that I learned very early on while we were getting this was this overlay thing. I mean, I've been in the business 30-some years, and I have never heard the term overlay. And when you explained to me that obviously, we're not lending our money. Todd and Amir are not lending our money. We get money from banks, but that there are institutions out there that are putting these extra overlays on things, and that we have very, very limited overlays, which makes the process easier, and we have more control over this. I thought there's a differentiating thing of why would you go with this mortgage company versus that mortgage company?
How many layers do you have to go through to get approval?
Yeah. How are they putting up stops and slowing your potential buyer from getting their loan? So we have very few, correct? That are in addition to what is mandatory.
Correct. Not only do we have very few, but we have several options of investors. So we can provide different underwriting guidelines for different types of borrowers. We can provide different pricing for different borrowers, different turn times, all kinds of different things that we are not attached to one specific set. One of my favorite questions I think I get is, do you guys have in-house underwriting? And my response is always the same, which is, what is that? And the reason I respond with a rhetorical question is because I would say about 2 out of 3 agents that ask me that question don't actually understand what in-house underwriting is. Any underwriter, whether they're in-house or not, has to go off the guidelines through Fannie Mae, Freddie Mac, FHA, whoever it is, at their minimum. They have to subscribe to those guidelines, or else the loan won't be securitized or insured later on. So for us, we have really incredible amounts of flexibility with underwriting guidelines, and we try to put together, place somebody with the best investor that fits all of those boxes or checks all of those boxes. But yes, a lot of our investors have some of the fewest overlays that you have in the industry. So our underwriting guidelines are very, very flexible. Now, they have to still meet those minimum requirements that Fannie, Freddie, FHA, whoever it is, requires. But right now, during the pandemic, that's a huge advantage for us. It's one of the reasons we're able to very strongly pre-approve people and close loans quickly. And it's a big reason we had no loans that we pre-approved that didn't close last year.
Awesome.
Nice. Well, I think we've hit all of the questions. By the way, Erica and Mauricio both said thank you for the answers that you provided on their questions, Amir. So.
Yeah, and again, even if your client's not using us for their loan, but you got a question, Amir's wicked smart.
So knowledgeable.
He's very knowledgeable. Feel free to use us. Ask questions. Build up your self knowledge. I think hopefully this was helpful for everyone. It's great.
And if you're not using us, but you have a lender you really love, and I'm sorry to interrupt that. I just wanted to
go. Yeah.
Thank you, Mac, before I forgot. Sorry for the interruption. So rude. Make sure your lending partner, whoever it is super strong and is looking at all the details if you are taking those contingencies off of your contract. Right? Ultimately, that's who you're relying on to protect your buyer, which is the most important thing for all of us, is to take care of our buyers. So, if you're not using us, make sure they are doing, dotting their I's, crossing their T's, and checking in and digging into all of the pieces. And sometimes that's a very quick process for people who've been on their job for a couple of years or salaried, whatever, and sometimes it can take longer. So, make sure your lending partner is doing that for you.
Yeah, no, good.
Yeah, and very good point.
Piggyback on that. This is not your decision.
Yeah.
Please do not make it, hey, Mr. Buyer, let's waive this, let's waive that. I think you're good. No. This is, we're giving you advice to give your clients so that they can ask the appropriate questions, and so that at the end of the day, they're not going, well, I thought I had to have these things. I didn't know I could waive those. I'm fine. People don't know that
they need options,
yes.
But it's not for you to tell them this is the best route for you to go and make that decision on their behalf.
Yeah.
But to say, hey, we could do this, we could do this, we could do this.
Yeah, just You're just giving people knowledge, giving people information so that they know what their options are, so that maybe they can go get a house, because it's crazy.
Maybe, right? Just a quick shout out from Terry Cooper. Kudos to Amir, my first time home buyers pre-approved for a conventional with 3% down, no extra cash. Fortunately, my buyers were willing to go to Loveland, got under contract yesterday, yes, and no competition, no appraisal gap, no escalation, no inspection limitations, and a $3,000 seller concession. Amir has been fantastic.
Wow, Terry, way to go. Good offer.
Thank you, Terry.
And good job, Amir, getting someone approved 3%, not FHA.
Yeah, that's awesome.
Awesome.
We love those success stories. So, all right.
All right,
Thanks
have
for
a
your
great
time.
week. Keep plugging ahead, guys. I know it's tough out there, but proud of you. You're working hard.
Somebody has to win.
Yes.
All right.
Bye, guys.
Thanks, Amir. Appreciate it.
See ya.